State of the market. So we're Nick and Elaine Stoggeberg, owners of Black Swan Real Estate. We'll do a little introduction slide here to give you all some sense of our experience and why you might want to listen to what we have to say. Most of you know us, but for those of you that don't, we'll start with that introduction slide.
Yeah, and we wanted to talk about the state of the market because people, every single day, people will reach out to us and say, hey, how's the market doing? Is now the time to buy? Is there a bubble? What's going on? And clearly there's just a lot of demand for that. So we want to have a nice kind of reusable segment here. Maybe we'll do this with some regularity, kind of talk about the state of the market and what we're seeing. We just wanted to bring as much value as we can to our community as possible here. So yeah, you probably know a little bit about us, just a little kind of credibility slide here. So we've bought a lot of real estate and managed a lot of real estate for other individuals. We're in partnerships with many of the people on this call here, and done some ground up construction, raised a bunch of capital. So just a little bit of background so that you have some notion of why we know a little bit about what we're talking about.
Yeah, so in any given day, Nick and I are spending our entire full-time careers in real estate. We have a real estate team, so we're out there looking at properties every single day. We used to say we look at about 1,000 properties per year. I think we actually look at more now as our team has grown, and writing a lot of offers. And so we have a very clear pulse on the market here in Rochester, Minnesota. We're about an hour and a half south of Minneapolis, St. Paul, but certainly what we are seeing here in this market correlates to what's happening in the rest of the market across the country. So we speak from a position of authority of Rochester, Minnesota, but know that this does apply nationally. And that's what we're hoping to get in the Q&A, is to kind of get some sense of what are you all seeing in your markets, and how can we all learn from each other. So if you've gone on to any popular news site or read any newspaper or even just talked to any friend, you likely know that we are in probably what is the best sellers market perhaps in all of real estate history right now. And that's why we wanted to talk about this. So Nick and I have been very actively investing for at least 10 years. Depending on kind of when you count our first investment. We kind of came of age in the 2008 crash, and that has kind of shaped our whole perception of our investing career. But we are in the craziest market that we have ever seen, and want to kind of share some of our insights of kind of how that came to be, what we're seeing day to day, but then most importantly for everyone listening, how you can use this information to influence your own investment decisions. We'll do our investment disclaimer that this is all just entertainment. Don't take our advice for as legal advice or accounting advice, but hopefully you can learn from it. We can all learn from each other. So Nick, why don't you talk a little bit about this picture and what you're seeing as a real estate agent?
So this is a typical picture in Rochester here, and this is a typical picture around the country. Literally a line of people to get into a property to show, like literal lines, and it's tough doing overlapping showings with COVID, and it's certainly a seller's market, and it physically feels that way when you are visiting the properties. We have to see a lot more properties, write a lot more offers than we used to. But when you go do a tour with a client, you can physically feel the intensity of the market. What does this look like? What does this mean? I think for most people, they might identify with a chart like this. We've got some charts, a bunch of graphics here to share with you. People think seller's market, and they think high sales price. That's not quite how single family homes work. And the reason for that is single family homes transact based off of a sales comparable appraisal. If it's a finance purchase, which most single family homes are finance purchase. If the property transacts over a certain level, there's no historical data to support that. The buyer needs to make up the gap between the purchase price and what the appraiser says the home is worth based on historical data. So there's a safety valve in the market to prevent the market from going up too quickly. So we know that sales price is a trailing indicator of the state of the market. It can take months and years for price to catch up to an accurate reflection of demand level. So This line of people right here does not mean that this home is going to transact for double the price it might otherwise sell for. It might transact for 10% more, maybe 15% more at very most. But this line of people means that houses sometime in the future, months, years from now, probably will transact for double the price that they're transacting today. This is a critical concept that I hope everyone here understands. And of course, there's a lot of assumptions, that's looking far into the future, but it's important to understand that the supply demand interconnect in the single family real estate realm is very time dependent. It's not an instantaneous curve there.
Yeah, so let's slow down and take a look at this graph here. If you're on your phone or something, try to safely get to a place if you're driving where you can look at this, because this is really going to inform the next many minutes of our presentation. So here we are looking at MLS data. So those are properties that are on market. We're not capturing off-market properties in this data. We're capturing the Twin Cities region. So we're in Rochester, Minnesota. We're south of the Twin Cities, but this is the largest metropolitan area that's closest to us. And then we're going back to 2016. So here we're looking at median sales price, and the graphs to follow are going to match this in terms of there'll be the MLS data from the Twin Cities going back to 2016. And what you see there with that wave is seasonal variation. So that's normal. Any real estate agent or anyone that is in real estate would know that the vast majority of markets have seasonality. That's extenuated in a market like ours where it's very snowy and cold, but it holds true really across the whole country. Even when there aren't like weather changes, there's still societal changes throughout the year, like kids going back to school, summer vacations, those sorts of things. So we see that price goes up in the spring and summer, but it comes down in the fall and winter, and then it goes back up. But you'll see that over time, since 2016, prices have steadily gone up. If we had a flat line there, it would be an upward slope. Throughout this entire time, so this represents about half of Nick and I's investing career. Throughout this entire time, people have focused on the rising prices and have said things like, a crash is coming, or prices can't continue to go up.
I'm going to wait for the next crash.
I'm going to wait for the next crash. And I think a lot of that comes from, the vast majority of people listening here lived through 2008 and were financial adults in 2008. And so we are that feeling of a crash coming is like built into us, the same way like people who lived through the Depression, or all of us, probably have different ideas about, say, infectious disease or large crowds because we've lived through a pandemic. That's going to be hard for us to shake off. That's right. So understanding this graph and understanding the time frame and the overall trends is really important, because that's going to color our next several slides here.
And one thing that's important to understand here, so this graph, it's gone up 50% approximately in the last 5 years. This is about as much as appraisers will let it go, right? So there would need to be people bringing a lot of cash to close to make up gaps in appraisal and stuff for this graph to go up any faster than this. There'd need to be some very unusual market dynamics. So this straight upward consistent line, this is reflective of the role that financing appraisal has in the real estate process. So, we were talking about how this is a slow, time-sensitive supply-demand thing. You can see this is almost like synthetic, how consistent this is. This is because this is as quickly as appraisers will let things appreciate. So we know that price is a trailing indicator, sometimes significantly trailing. Let's look at a leading indicator.
Let me take just 1 second to talk about what a leading and trailing indicator is. I prefer to use leading and lagging because I like the L's together. So a leading indicator might be things like, what are you eating today? Are you eating good, healthy salads all day, or are you eating fast food all day? And then a lagging indicator would be your weight. So leading and lagging, have an understanding of what those mean in terms of real estate.
All right, so price is an outcome that is downstream of other dynamics. So I would argue that the statistic that would most immediately predict price would be the number of showings per listing. So here's what that chart looks like for our for the Minneapolis MSA. And this is you have to have direct MLS access to produce this data. So this is like up to the second data. So that's why you don't see these kind of charts on, CNN or Zillow or whatever. So you can see there's a pretty radical change here. You can see that seasonal variation, and that seasonal variation directly correlates to the price, doesn't it? The price goes up and down in conjunction with the season. And the reason for that is because there are more showings per listing, more people looking at the house, there's more shoppers, and so more chances that someone falls in love with that house and they're willing to pay whatever they need to pay in order to get it. And you can see there's this hockey stick there on the right side of the chart. We have never seen this many showings per listing before, ever. And realtors have data going back half a century. 25 showings per listing up from 10. So this chart here is this situation right here. This line of people is the 25 showings per listing. And knowing that this is a lead indicator and price is a lag indicator, what does that maybe tell us? Maybe.
What do y'all think? Put it in the chat. What do you think the picture that we're trying to paint here is? We're understanding basic supply and demand economics, going back to high school or college, kind of dust those brain cells off. Let's think about more and more people want a fewer number of homes. The seller's market.
Yep.
What else?
There's not enough supply to meet
demand. Not enough supply. Yep. So if we're all at the beach and we all want ice cream and there's not enough ice cream, what happens to the price of ice cream? Seller's market will get worse.
That's right.
Bidding wars. Yep. Prices will increase.
Yep.
But limited by appraisals. Absolutely. Yep. Very good.
Tight inventory, you're a step ahead of us. So let's take a look at the inventory situation. So most economists would say that it's 6 months of inventory is like a healthy amount of inventory. And we had like a year of inventory after the 08 crash. And every single year that's gotten tighter. So every single agent who's been in the business for a while, you talk to them and they'll tell you, yep, inventory is getting smaller and smaller and smaller. Every single year there's less inventory than the year before, and they can feel it in the number of offers that are submitted against a listing they're trying to buy, and the number of offers they receive on a listing. And this right here is the principal reason why Elaine and I have been investing in single family real estate so aggressively for the last 5 years, is because this is an entirely predictable data trend. There is a game of musical chairs. There's a certain number of houses out there. And after the 08 collapse, there were a lot of extra chairs. Mm-hmm. And it's been, fewer and fewer chairs, and people have to scramble a little bit more to get a chair. And then this spring, we ran out of chairs. And all of a sudden, people will pay whatever they need to pay to get a house, any house. And this isn't a linear progression like you see in this price chart here. This is a logarithmic or exponential kind of progression here. And you can make some probably pretty accurate guesses about where pricing is going to go in the near future with a significant amount of accuracy. Similarly, and this is one that realtors feel really painfully, this is the number of listings. So if you just go back even a few years now, this was double this 10 years ago. 4 million people in the Minneapolis MSA. It's a very large MSA. And we've gone from 10,000 homes to 2,000. I mean, you go to look up, do like a home search, or whatever, and when you're using the tools, like you go to skip to the next page to look at more results, and there's no more next page. There was a next page yesterday, but there isn't today. Mm-hmm. So it's not even a question of supply and demand, which is an inventory calculation. It's how many things are there, like you're trying to help a buyer buy a home, and you have nothing to show. There's not even a home to show them. So it's hard to wrap my brain around an MSA with 4 million people and 2,000 homes for sale. But that's the reality of the situation. You can see all these are very recent and very sharp trends in the economic data. So all these questions, of course, lead to the $1 million question that we get every single day, which is, are we in a bubble?
Yeah, so I would say Nick and I get this question at least once a day. Often more than once a day, people will call us because they know we're in the single family space and ask about what we're doing, what they might want to do. Are we in a bubble? Again, going back to what I said, we've all came of age in 2008, which was the worst economic collapse since the Great Depression, hopefully the worst we all see in our lifetime. And so we have that feeling of feel right, or I'm seeing some crazy things out there, or what do you think? What are you seeing boots on the ground? And I hope during the community time we have time to talk about maybe what you all think about whether we're not in a bubble, or Nick and I are going to share whether we think we're in a bubble. And long story short, we don't. Long story short, we are still very much excited about single family, investing in single family, scooping up as many of them as we possibly can. They are harder and harder to get, but I'll tell you, we are very excited about the single family homes that we already own, and
Absolutely.
all of the homes we've been able to purchase for ourselves and our clients.
So there's a key piece of this equation that we haven't talked about yet. So real estate's not a game of musical chairs, so to speak, or maybe it is, but they're making new chairs, right? But here's what that looks like. So after the '08 crash, a lot of home builders went out of business. And the home builders that stayed in business, they used to do tracks of spec homes, and they would just plan to make a lower margin on each home, but they could build a lot of homes and they could make a healthy profit that way. '08 changed that calculus drastically when, 3 out of their 4 buddies in the home building business went out of business. When they couldn't sell any of those homes in that track of spec homes, they said, well, shoot, I'm never doing that again. There's a whole generation of home builders out there that don't want to build spec. And as a result, we have underbuilt just a little bit. I think this graphic tells the story really acutely. We went from building 27 million homes between 2000 and 2009 to 5.8 million homes between 2010 and 2019. And the situation's getting better right now. Home builders are responding to the demand, but we're still not seeing huge tracks of spec homes. That's just not something that's happening. There's a lot of drivers for that. There's a huge escalation in material costs. And so a lot of builders are saying, well, a $2 2x4 now costs $9. I bet that is going to be $2 again at some point in the future. If I build a spec home now with that $9 2x4, well, I'm going to be left high and dry with a greater sunk cost into this property that I can't sell for that same exaggerated price, because someone will go build a house 6 months from now when the 2x4 is back down to $2. So even today, we are not even coming close to catching up to this. And we could see in those previous charts that this has been a problem that's a long time in coming with that descending inventory curve. And every single year, every single agent I've talked about is like, gosh, in just a few more years, there's going to be an inventory crisis. I mean, 3-4 years ago, agents were talking about, right about 2020, 2021, there's going to be an inventory crisis. Builders aren't building enough. More and more homes are being consumed by millennials who are finally moving up to home ownership. And pretty soon there's going to be no more houses to sell. This is a problem that's been foreseen and discussed at realtor conferences for years. And it's not really getting any better right now. The solution to this problem has yet to be discovered. And hopefully material prices come down. Hopefully there's regulatory changes that make lots more affordable. There were numerous building code changes right around 2016, 2017. International building code changed, and a home in our market could go from costing $700,000 for construction to $800,000, a $100,000 cost escalation as a result of those more stringent building code standards. So we're going in the wrong direction here in terms of our country's ability to build its way out of this problem. And that's what it has to do. Our country has to build its way out of this problem. And even if we could get it figured out, even if we could wave a magic wand tomorrow and say that house that you could build in 2015 for $300,000 that now costs $450,000 to build, we're going to turn back the clock and you can build it for $300,000 today. Even if we could wave that magic wand and unroll material cost escalations, labor cost escalations, regulatory cost escalations, building code cost escalations, it would still take us half a decade to build our way out of this problem. It took us a decade to get into this problem, and it's probably going to take us a decade to get out of it. And we've seen this story before, right? This is not a new story. It's just new that it's happening on a national basis. So one day in, let's say, San Francisco, a single family home costs $300,000. And then all of a sudden the next day, a single family home costs $700,000 because we ran out of space. There were regulatory and other cost constraints that made it prohibitively expensive to infill or create new housing units. So there was a limited amount of supply, an escalated cost of replacement, and just incrementally increasing demand. And all of a sudden, there was an explosive increase in the cost of that asset. And it's never going back. I can't imagine a world where it doesn't cost $1 million to buy a home in San Francisco. There's perennial economic drivers there that are probably never going to turn back that clock. And let's be clear, this is not a good thing for the United States. Home ownership, the American dream, this is a powerful thing that we love and support. We love selling homes to our tenants. We love helping people build homes. We're building 85 homes right now, trying to do our part to solve the problem. And it's really hard because we're building townhomes. They cost $200,000 to build in August, and they cost $240,000 to build today. It is really hard to solve this problem working against those kinds of market forces. But these are market trends that you need to be aware of. They are probably bad things, but they directly inform what you should probably be doing in terms of your investment strategy. So as soon as we share this information with people, that we're not in a bubble, and this is a problem that took us a decade to get into and is probably going to take us a decade to get out of, or at least half a decade. The immediate next thing they say is what?
What about all the foreclosures?
What about all the foreclosures?
All these people have not paid their mortgage during COVID with all of the relief packages that came. I'm just waiting for the foreclosure. So a year ago, or let's say pre-COVID, let's say 18 months ago, we were hearing, well, I'm just going to wait for this crash to come. And we would say, well, keep waiting. We've been investing
we're going to keep buying.
At that point, we had been investing for about 8.5 years.
Meanwhile, we watched that inventory curve go down every single year.
So really understanding the data and the economic drivers behind it. So we thought there's no crash coming. We feel very confident in rising rents, rising home values. We're going to continue to invest. And yes, it hurts to pay, say, we were paying, say, $200,000 for a house that, say, 3 years before we would have paid like $160,000. So we were feeling that pressure, but continue to invest, continue to have faith in the data. And now people are saying it's like there's like a feeling of wanting to be clever. Well, I'm going to wait for these foreclosures to come. That's also a thing that we just don't think is going to happen. We feel very confident in the rising value of home prices, the rising rents, and we don't think this wave of foreclosures is coming. And let's think about how that compares to 2008. So 2008 was predicated on a failure of lending, of people buying homes that they really couldn't afford, falling behind on their mortgage, and then needing to make a quick sale to be able to get out from under their house. When you have one or two people doing that in a neighborhood, it's not that big of a deal. They can get out of their house. There's plenty of buyers. Things carry on. When you have swaths of the population doing that, well, then you have the opposite of what we have now. You have a lot of supply, a lot of people needing to get out of their homes fairly quickly because the foreclosure process is long, but it's not that long. So people need to dump their housing stock very quickly. And that lowers the value of homes because it inverts the supply and demand curve. But that's the exact opposite of what's happening now. So if someone is, let's say they've hit some hard times in COVID and they haven't made their mortgage payment for a year, let's take aside the fact that we have a Democratic leadership right now that will likely try to keep people in their homes and pass policy to do that. Let's take that off the table for a second. When that person gets the final notice from their bank that a foreclosure is definitely happening, all they need to do is call any real estate agent in town with a pulse and say, I would like to have a line of people outside of my door. And so long as this group of people is, say, there's probably 10 people in this picture, that person will be able to sell their house very quickly. They will have plenty of equity to pay off the bank, cover any debt they had, any outstanding bills, and then likely walk away with quite a bit of cash. And there are so many buyers in the pool and so limited inventory that even if we have this wave of I'll call them foreclosures. And for those of you that aren't watching, I'm doing my air quotes. Even if we have this wave of potential foreclosures, there's plenty of equity, there's plenty of buyers, and there's so limited inventory that those people will be able to sell their home at a very good price and not have to go through all of the foreclosure process. And because of that, on a neighborhood and an MSA and a national scale, that's not going to lead to radically decreased prices the way it did in 2008. So very different fundamentals in the backbone of the economics that we're talking about here. And it really takes understanding those pieces to project forward and not to get kind of caught up in that, like the news hype or the cycle of, well, we're in the longest expansion of real estate values in history, or all of my friends are saying a crash is coming, so I think a crash is coming too, or all of these foreclosures are coming. But really taking a step back, going back to high school economics, college economics, thinking about supply and demand, and realizing that this wave of foreclosures is likely not going to come.
Another interesting thing that most people don't have a lot of visibility on is that we had a chance, for example, to meet with one of the main guys that taught Blackstone how to buy foreclosures, and Blackstone actually put him out of business. They said, join us or we'll put you out of business, and he chose the latter. And
Nick, why don't you give just a one sentence of who is Blackstone? Why do we care about Blackstone?
So they're one of the largest agglomerators of capital in the world, and they go out and they buy things. They place capital wherever capital can be placed. They buy oil tankers and commercial real estate and bonds and equity stocks. And in the past, these large organizations didn't buy single family homes. That was a largely naive market that mom and pop organizations like Elaine and I would dominate. So Elaine and I would go to the courthouse steps and buy a foreclosure. And that market has matured. It is not naive anymore. And so Blackstone has franchises with billions and billions of dollars of capital, an unlimited amount of capital to go buy foreclosures in most of the major metros in the United States. So even if there is a wave of foreclosures, once a week probably I have someone reach out to me who is raising capital to buy foreclosures, or is asking me how can they find someone who's raising capital to buy foreclosures because they want to get in on this opportunity. And that tells me that opportunity isn't going to come. There is so much capital.
This reminds me of, so Nick and I are in a very high level mastermind. And someone, this is just completely ad lib. This was not part of the presentation. Someone
make it sound like any of this is not ad lib.
That's right. That's true. Someone posted in there, is anyone here interested in distressed commercial real estate? And it's a group of, I don't know, maybe 700 people. And there were probably like 250 comments of, yes, me, call me, here's my email, give me the deal, what's the information? And then the smartest person in the room said, if there are 250 people interested, is it really distressed?
Mm-hmm.
Is it really distressed? And that's what we are seeing in the real estate space, and certainly in the single family space, going back to supply and demand.
Absolutely. Yeah. So we can be very confident that there's no wave of foreclosures coming. Let's
talk about a couple of real deals live. We got these, both of these in the last weekend here in Rochester, Minnesota. So they're your deals. So why don't you talk about them?
Yeah. So we have to look at a lot of properties these days, and we have to write a lot of offers to get a lot of deals. And to be honest, we're not buying so many properties for investors right now. We're buying properties for owner occupants who are willing to write offers that are way over asking, and whatever it takes.
More emotional decision.
That's correct. Yeah. And
let's talk a little bit about what we consider to be market norms for ourselves and for our investors, say going back like 2 years. We liked to get about 30% of our offers, maybe even 20%, because as investors, if we're getting 100% of our offers, we know we're paying too much, we're being too aggressive, we're giving too much away. If we're getting 0% of our offers, well, then we're just tire kickers and we're kind of wasting time. So we would counsel ourselves and our clients, if we're getting about 1 in 3 offers, we can buy. We're paying enough to be competitive and to get in, but we're not just giving away money. And that has radically shifted over the last several months, and really even several weeks. So now we're getting what would you
1
say,
in
maybe
20?
5%? Yeah, we
it's-
came up with
it's-
that number at the same time together, so
Yeah.
that's probably what it is.
We will go write an offer on basically everything, even for one buyer, knowing that there's just no way they're going to get two of them. And so we have to just totally reinvent the way we approach it. We used to be riflemen where, okay, this is the best deal on the market today. We're going to get this one property. We don't want to go write, 5 other offers for that buyer because we're going to get this one. And we just can't do that anymore. The market is moving so quickly, it's tough for us to predict. So last week it was 25,000 over asking was what it took to get it. This week it's 35,000 over asking. And so let's look at a real deal here. So this one was one we actually did get for an investor. We looked at it for an owner occupant, and the owner occupant didn't like it. So I called an investor and said, hey, we've got a deal on the line. Can you write an offer right now? The reason why we got this off, so it was under marketed and included some terms that would not be acceptable to a owner occupant. So basically, the sale needs to be contingent upon the seller finding housing that they haven't even yet looked for. And again,
There's no inventory.
There's no inventory. So
I bet we could offer them a rental.
it might come down to that, yeah. So there's no telling if this will even go through, but they're investment buyers, they want the deal. So we're going to hang on for 6 months if we have to in order to close. And I was able to kind of psych up the listing agent and say, listen, you're probably going to get some offers. However, I'm guessing you're not going to get another offer like this one. So it's all cash, no contingencies, close the day you're choosing. I will call the listing agent of the home that your buyer, so the seller of this home, is trying to buy and say, yep, we are definitely closing no matter what, because their offer is contingent upon the sale of this property, which means their offer has no chance of getting accepted in a seller's market. Their offer goes to the bottom of the pile. So the listing agent knows what he's up against and counseled the seller to accept our offer that was well below other offers. And they didn't get very many offers because the terms were so crazy. Who knows if this will close? I think it will, because we are just so determined. It's going to be a lot of work, but I think we're going to get it closed. But this is what a deal looks like in the market right now. You need to be kind of clever. You need to be creative, and you need to have an agent who is willing to do some hustle.
A little bit about cash. So Nick and I have always purchased with cash. We've done a lot of things in our business to stay very liquid, to be able to make cash offers. We've encouraged our clients to do things with their own liquidity, to be able to make a cash offer, do some renovations, and then do a cash out refi. So you're tying up that liquidity for, say, 6 months at most. And we're just not seeing that cash matters.
Yeah.
And it actually took us a little while to figure that out.
Yeah, we were very confused.
Yeah, we got dozens of rejections, and we have great relationships with listing agents in town, and they would say, well, we took a higher offer, but it was financed. I'm like, what are you doing? Like,
how the financing's not going to close.
The appraisal, all of that.
Yeah.
Take a moment and think about why cash maybe doesn't matter as much anymore. Throw it in the chat if you can think of something, or just think it in your mind. Nick's going to give you a hint. It took us a couple iterations to figure this out. I'll give you guys a couple more seconds, maybe throw something in chat. I'm curious to hear what you think, because this is just a hypothesis that we have. But it used to be, say, a listing agent might get, say, 2 or 3 offers. And if an offer was cash and they were certain, there we go. Good job. Yeah, you guys, I love it. Smart crew here. So they got maybe 2 or 3 offers, because again, we've been in an escalating market over the last many years. But they needed to take that cash offer because those other buyers, if something fell through with the first buyer and they called buyer 2 or buyer 3, chances were that those buyers had moved on. They had already purchased another home, or were under contract, or maybe had decided to rent or just stay where they were living, or whatever. They didn't have a lot of kind of rope to work with. And
they might have to go relist on the MLS.
Oh yeah, going back from,
now it's a tainted listing.
From pending to active. Yep. I mean, you just have to assume that the foundation's collapsing and it's haunted and the roof is terrible. I mean, as a buyer, you just kind of have to assume like, oh, that's something's dirty about this listing. Well, you guys, said it right there in the chat. There's 10 people behind. There's plenty of offers. So
and they probably haven't found another house if it comes back around.
That's exactly right.
There's no other houses to buy.
That's exactly right. So not only are there more buyers, but they're hungry buyers who likely are still available. So you can take a weak offer with terrible financing from some bank that you're not even certain it's going to close, and they've, the listing is at 250 and they promise 300, and you're like, I don't really think we're going to get 300, but let's try it, because if not, I have 20 buyers behind that I can just call, and one of those 20 is going to take it. So no, we shouldn't take, say, 275 at cash for the certainty of that, because why would we? Between, say, 300 and 275, we have 5 more buyers that their financing gets better and better, and then maybe there's a cash buyer in there.
Here's the
And
craziest
we
thing
have
of all.
never seen that in our 10 years of investing.
If that house comes back around on the market 90 days from now,
It's probably worth more.
it's probably worth more. Prices have probably gone up 90 days from now.
That's right.
So who cares?
That's right.
It's
We'll have
interesting
stuff
dynamic.
under contract, and we're like, oh, this one's kind of thin, and then we'll close like 60 days later, and we're like, oh,
What a great deal.
thank gosh we bought that one.
This was a March deal. Wow, we got an amazing price on this thing.
That's right.
The
That's
May
right.
deals, whew.
So this is what we're seeing in, this is Byron, Minnesota, small suburb, basically part of Rochester, Minnesota. Again, kind of to orient people, about an hour and a half south of Minneapolis, St. Paul. So certainly not a large city. And typically the smaller the population center, kind of the softer things are. So we look to Minneapolis to see, what are we seeing there? When we were seeing, say, 10,000 over asking to get a deal in Minneapolis, it was 25,000. Now we're seeing 25,000 here. And so we're looking to Minneapolis and seeing, okay, up there, it's more like 35 or 40,000. What we see in Minneapolis is buyers paying sellers closing costs. That's not something we've
There's
seen.
not even a box to check on the form.
Yeah, you have to like hand type it in. It just doesn't exist.
Yeah.
So we're thinking, okay, we're probably going to see that here in Rochester in the next, 30, 60, 90 days. What I've not seen I personally have not seen in any market yet, is the buyer paying for their own real estate agent.
Mhm.
So it's just convention. It's not a legal contract or anything. It's just convention that the seller pays the listing agent, and then the listing agent then splits that, typically 50-50, but it can go up or down a little bit with the buyer's agent. And I think what we'll see in the future is the buyer will have to pay their own agent.
Which is how it is in commercial real estate very frequently.
Yeah.
Because your offer is at a huge disadvantage potentially if you are asking for a split on the sale. So you pay your own agent in order to get an advantage on a competitive commercial listing. So
let's talk about something in a bigger market.
And by the way, so on this property, so we were shopping for an owner occupant. It was a financed offer, no contingencies. If there was a gap on appraisal, the client would cover it with cash, close on the date of the seller's choosing, making it the strongest possible offer. And this home was nothing special. So we wrote at 270 and we did not get it. They went with another offer. So list price of 246. We offered 270. We didn't get it. So we're 25,000 over asking. This is just it's a nothing special home, and not a bad home, nothing wrong with it, not distressed, but certainly nothing special. And it's very important to understand that the desirable properties, the ones that are freshly flipped and stuff, you could potentially double these numbers. So about 15% we'll say over asking in this circumstance.
I think we're missing a slide there just to kind of orient people. So one deal we got under contract, one we didn't, but there's just one slide there.
Oh, you are correct.
Yeah.
Thank you for that graceful recovery.
So we need to have two Zillow screenshots in there, and we didn't. But just to say that we were sharing one example of a really strong offer that just got passed over.
The homes look identical. That's the point.
Yeah.
One we got, one we did not get. The one we got was because we were clever and worked with some really challenging terms from the seller.
Let's try to wrap up in about 5 minutes so we have time for questions.
Here's a deal in California. So listed for $2 million, sold first day on market for $2.4 million, 400,000 over asking, 20%. This is not an uncommon thing to see. In some markets like Austin, it's even worse.
Okay, so let's talk about, is now the time to buy? So this is a question, we've been alluding to. Nick and I have been asked this our entire investment career. To be clear, we ask it ourselves when we're like putting the kids to bed at night. We have some spare time. We're like, should we still be buying? And the answer has consistently been yes. And over the last, let's say, 3 months, certainly the temperature on that has risen of, should we still be buying? More and more people are asking this. Are we in some sort of hype cycle? Are we in some sort of bubble? And I think we've talked through here, why we do think it's still a good time to buy, looking at the very basic economic data. There's some other reasons, some other things that are happening in the global economy that make it that we continue to buy. And we think that if you were wanting to buy too, you should consider buying too.
Absolutely. So the cool thing about real estate is it's a hard asset leveraged by paper debt. So what that means is if you can get paper debt that's really cheap at a low interest rate, and you can buy a hard asset that will appreciate, there's an arbitrage there. So let's say there's 3% inflation, the home gets 3% more valuable, but the debt does not. The debt gets cheaper. And because you can get leverage, you have a 20% down payment, you can go buy 5 houses instead of 1 house. And if you bought that 1 house and didn't leverage it, you're probably better off just parking your money in the stock market. But that leverage is what sets it on fire and allows you to get returns that you can't get in almost any other asset class. We know that interest rates are very low right now. The Fed is buying, I forget what the number is, like 40 billion per month in mortgage-backed securities. So the Fed could go out and buy anything, right? They could pump money into the economy any way they want to, and they're very specific in the way they do that. They could go buy pork, and then pork would get more expensive. They could they could go buy treasury bills from the U.S. government, and that would make the U.S. government national debt cheaper. Instead, they choose to buy, and they're doing that. They're doing both of those things actually. But what they do is they choose to buy mortgage-backed securities. So they are artificially suppressing the interest rate, keeping the interest rate on home loans down. They're probably not going to do this forever. And we have the lowest interest rates in history. Here's a little graphic to reflect just how crazy the interest rates are for a little bit of historical perspective. I don't think that 12% interest rates are on the horizon. I'm not a person who has huge inflation fears like that, but just for a little bit of perspective of how extraordinarily low the interest rates are right now. And it's also important to understand the concept of inflation, because you might see on the front page of CNN that there's not inflation. Well, there's not consumer price index inflation. So lots of things get cheaper every day. Energy prices go up and down. A gallon of gas is cheaper than it was many years ago.
Technology helps a lot with that.
Yeah, technology is deflationary in nature,
Yep.
and it reduces the inflation adjusted price of commodities like potatoes or tube socks. Hard assets, durable goods that have resale value, those things have been increasing in price drastically of late. There's been significant hard asset inflation for quite some time, and homes are kind of the biggest, most durable, most accessible hard asset that most people are able to buy. Most people can't go purchase a tanker of oil, but they can go buy a single family home in their community or some community in the country. So we know that interest rates are low. We know that there's probably going to be some hard asset inflation. And we know that when you go buy a single family home or any investment property, you can go buy a hard asset that's leveraged by paper debt.
Yeah. Good stuff.
So
I like that.
how do you get a deal? I mixed up my slides there. I apologize for that. Here's one other deal. So we know we want to buy houses. Here's one other deal that we got recently.
Well, let's say, how do you get a deal as an investor? So
Yeah.
as an owner occupant, the answer is pay as much as you possibly
That's
can.
right.
If that's your dream home and you see yourself in that home, that's an emotional decision. The people listening here want to know, how can I still be a savvy investor? How can I still get good return? How can I maybe still get some cash flow? How can I buy smart?
Yeah. So this property hit the market. I don't have perfect insight into what the seller situation was, but it's a situation where the property was not ready to be marketed, but they wanted it to sell, and they know it's a seller's market, so they could. And sellers are doing that. They are they're selling homes that are really not in a condition to be sold. So this is a half occupied duplex. It was not possible to access the other tenants, the occupied unit in a reasonable amount of time. I think we were probably the first showing that was permitted. So we had a local buyer who had just instant agility. We knew this was a deal the second it hit the market. And this client has purchased many homes from us. They buy with all cash, close in 7 days, and they target this specific area. So we knew that they'd be willing to make an immediate offer with whatever strength was necessary to get the deal. So we actually made a full price, all cash, no contingency offer, having never seen half the property. And we just knew that that's what it was going to take in order to get the deal. And I actually did some relationship building with that tenant and said, listen, I just want to let you know there's going to be a line of people out here, all of them wanting to get into your home. I'm really sorry that you're going through this. This is a tough time to be a tenant in a tenant occupied property for sale on the MLS.
And she found out that it was for sale when the sign went into the yard.
The seller had not adequately prepared the tenant for sale, which is why it was not possible to access that unit. After building some rapport with the tenant, I was able to get a lot of information that no one else had, probably not even the listing agent. And that gave us all the information we needed to have in order to feel confident about purchasing the property. And when we did actually get into that unit, we were very ecstatic to see that it was as we thought. It was very nice. The vacant unit was trashed and the occupied unit was in excellent condition. But at the end of the day, it's kind of crazy, right? There's a lot of hustle that went into making this happen. And we had to buy a home, all cash, no contingency, 7-day close, sight unseen, to get the deal. So that's what it looks like to get a deal in the market right now.
Nick, what do you think the rents might be? I haven't seen this one.
Well, the in-place rents are $850. After turnover, probably 12 or 1,300 or something like that, with a small rehab. And then the other unit probably about the same. The person who's buying this is going to do a deep value add, do some structural things, do a really good cosmetic make ready, and then probably run an Airbnb that will gross 3% of their purchase price monthly. So they are going to make money hand over fist on this property. It's extraordinarily well located. It's a unicorn property that you can't get. And it's nowhere near the 1% rule or anything like that if you analyze it on like a conventional basis. But it's certainly what a deal looks like at this time. So this was that misplaced slide.
Yeah.
So
there's the slide.
Yeah,
if you'd like to look at that. So that gives us a little bit of time to connect with all of you.
Yeah.
We'd love to answer any questions you have, hear about deals that you're putting together or what's going on in your market, kind of get some sense of what's happening around the country. If you'd like to keep in touch with us, we have singlefamilyatscale.com. We have basically a library of videos there where we talk all about our investing strategy and how we've built our own portfolio and how we manage our own properties. Stay connected with these folks and this group at our Facebook group, Single Family at Scale on Facebook. You can reach Nick and I. There's our email addresses there, Elaine@blackswanteam.com. There's a typo in there, so don't cut and paste that. Actually type it out.
Black Sween Team.
Yeah.
I like that. We should.
And Nick at Black Swan Team. And then if you would like to sign up for our next community hour, which will be at the end of May, you can do so here. That'll get you on the list, get you the reminder emails, and we are going to discuss rental property portfolio analysis, so financial analysis. Extremely important, the most important skill to have, and certainly the most important skill to have in a very fast-paced market, because you don't have time to kind of sit around and spend a couple of days analyzing numbers. There was a deal earlier this week. I was communicating with someone and she said, do you think we can get in with contractors before we make a decision? And I was emailing her back to say, nope, I don't think that's possible. And like in the time it took to do that, the deal went pending. So you have to know how to analyze your numbers really quickly, make good decisions. And so that's why we're presenting on that next month.
So we got an excellent question here. In past years, what time of the year does the market tend to quiet down? And I feel like a real idiot here because if you can believe it, I didn't expect this hockey stick kind of thing to happen.
Mm-hmm.
So throughout the winter, we were buying lots of fantastic deals for our clients. We had 25 properties under contract in December, which is a lot. That's as much business as many agents do in an entire year. We saw a significant fall off in inventory, after the holidays, and so we kept telling our clients, "Well, just wait until inventory comes in the spring. Just wait until inventory comes in the spring," and that inventory never came. So if you look at historical variations, you can see that there's huge swings in the number of listings, the amount of supply, the amount of inventory, and typically what we see is most of the inventory for the whole year will hit the market in the spring and the summer, and then a lot of those properties will linger through the fall and winter. So they may have been listed in June, but we're buying it in November at a very good price. It's just a home that's been passed over time and time again. We finally are able to get the when the snow first flies,
Mhm,
that's when
mhm.
we look at every property that's been on
We
the
clear our
MLS.
calendars and we go shopping.
That's
Yeah.
right. Yeah, no one wants to get out the snowblower on that house that's been sitting on the market for 6 months, and they're usually very receptive on that first day of snow. So I have not been right in predicting what would happen. I don't think anyone could have been right with this kind of hockey stick kind of situation. But historically, we tend to have
October 1st.
yeah,
It's a big day.
September 1st things slow down a lot, and then a month after that, the sellers catch up with the reality that all the buyers have gone. So as soon as school gets back into season, like 90% of the buyers disappear from the pool, and the listings data tends to lag behind that reality. I can tell you, if we have a rental that doesn't get leased by September 1st, we might be sitting on it for a while.
That's right.
And same
Yeah.
thing with the retail listing.
Yeah.
Yeah.
And that leads to thinking about our strategy for some of the properties that have been sitting on the market for a little bit here in Rochester. Nick and I have seen all of them in person, and we have hungry buyers. And so some of them are coming back and saying, well, what about that property? It's been on the market for 30 days or 45 days, which historically is not that long. That's a reasonable time. We personally own lots of those properties in our portfolios. And I don't know that this is like the gospel truth, but certainly the thing that we're talking about is it might not make sense to purchase those properties, because if all of these buyers, all of them have said no thank you to that one, I don't think we can blame it on poor pictures, or it's a little bit dirty, or it was listed on a Wednesday where there was a big thunderstorm or something and buyers didn't go out, so the listing got a little stale. Those are things that historically, we would think back and we'd look and see like, oh, that property was listed on the day we got a foot of snow, so that's why 30 days later it's still sitting here. Well, the snow doesn't mean it's a bad property. Let's go buy it. And that's just not true if all of these folks are saying no thank you. So our thought is, if a property today is sitting on the market for, say, more than, I don't know, what would you say, 30 or 45 days, like, it's probably not a good property to buy really at any price.
I'd say 1 week is equivalent to
2 months.
6 months.
Oh, really?
Yeah.
Okay.
In
So we disagree on a couple of things.
2018, yeah.
Because what I think of is, if that right now we are at seller's market, and if that needle goes even a little bit more toward a buyer's market, well, then all of these people that you see in this slide and all of their friends are going to say no thank you to that one, and that worries me. So that's how we're investing. We try to do a lot of just letting people know kind of what we're doing, and because we're in this space day in and day out. And I think if you take away one thing from this slide, it's that, or I'm sorry, from this presentation, is that old strategy of kind of picking up the stragglers as the market kind of softens. Like, maybe that's a risky strategy right now. Maybe it works. Everything works at the right price, but maybe don't think like, oh, I'll get that one for 10,000 off. It's a deal. Maybe think, oh, I need to get 50,000 off of that one, because all of these buyers have said no.
Yep, absolutely.
Yeah, and Glenda said probably no tenant appeal too. Yeah.
Are all those buyers looking for turnkey versus doing work? So it would be easy for us to just like say the sky is falling and woe is us. We've spent years building this business and all of a sudden it doesn't work anymore. Well, we've had to reinvent ourselves like every quarter that we've been in this game, because the business model that worked last year probably doesn't work this year. It's a moving target. The market is a constantly evolving thing. And I would say about 18 months ago to 2 years ago, that's when the discount for distress went away in our market. And it varies market to market. All these trends we're talking about, this is happening everywhere in the country. Our market is nothing unusual. And we looked at like Minneapolis stats in this presentation to give you more of like a national kind of perspective. But I would say that there is no discount for distress whatsoever. The ones that are dolled up, like they do transact for a premium, but there's no discount for distress. So if that property's worth $250,000 fixed up and it needs $50,000 in renovations, which is a gut remodel in my book, it transacts for $200,000. So
or worse.
Or worse. Yeah.
So it used to be you could buy with a profit margin, right? That was why you were willing to put in the work.
It would sell for $150. Yeah,
so
you can double your
make
money.
Some money.
Yep.
And then it just kind of slowly crept up. And then it was, well, you can buy it and rehab it and it's worth what the neighbor's worth, but isn't that nice? You have a brand new roof and it's freshly painted and the kitchen looks great.
Everything out.
So maybe that works. And now you're buying negative equity.
Yeah, because what happens is, so the best value in any market, if you're buying a car or a baseball card or anything in any market, the optimal point of value is never at the bottom of the market. It's frequently just below the median and then towards the top of the market. Those are typically the two places where you can pick up the most value. Like we have a property in our contract right now for 1.4 million replacement. So it's a home, it's an SFR. That's a lot of money in our neck of the woods. Replacement cost on that property today is at least double that value, but you're at the top of the market.
Is that with up-to-date lumber prices?
Oh, it's probably triple that.
Yeah,
who knows what?
Yeah.
They're getting a lot of house, but they're at the top of the market, so there's some value there. And then just below median. So median price in our market is 300,000. So we typically buy homes at like 270 or something like that right now. That's in any market. That's just always the case. If you get down to the bottom of the market, you are competing against people who that's all they can pay, right? So they only can spend $200,000. So there's like 3 houses they can look at, and they're going to buy one of those 3 houses because that's all they have is 200,000, and they don't care if they're buying negative equity. They're not.
Or they're willing to fix it up as they live there. They have a long range plan of, maybe I can afford to paint it this year and fix the kitchen in 5 years, whereas an investor needs to fix that kitchen, say that year, to move in a high quality tenant.
Yeah. Great question. Are you able to cash flow houses you're buying for 270? Yes. That's
in our market. Yes.
At this time in our market, yes. And we're seeing lots of rent growth. Rent tends to grow behind price increases. So we know there's going to be rent growth in the future because prices are skyrocketing. So the good news is you can cash flow. We are still in a market that cash flows. I think there's still a lot of juice left in our core market here. But 3 years ago, we could hit a 10% cash on cash, and then it was 8% and then 6%. I mean, we were able to hit a 6% very easily less than a year ago. And now really we're just looking to make sure we're cash flow positive. And that's pretty much what it comes down to.
One thing we think about with our personal investment strategy is that year one is typically the worst year. So that's the year that you're acquiring it, you have your closing costs, your renovations. Rents are likely the lowest during your hold period. So we target like at least a 10-year hold for ourselves. And really we think of ourselves as like indefinite buy and hold investors. Rents are likely to climb. And when we look back at deals that we did, say 3 or 5 years ago, that were nail biters, that were like, oh, this thing's going to have like really low cash flow. Well, today, and let's say we projected like a $1,600 a month rental rate. Well, today they're renting at $1,850, but the price of that home has stayed the same. Our mortgage has stayed the same, even if we have re-levered because it has grown in value and we've decided to pull out our equity. The ratio there has widened, and so we have cash flow. And so always kind of walking that dance of what are home values doing, what are rents doing, and that's why we wanted to give this like really up to the minute of what we're seeing day to day. So we're early in spring in Minnesota, and we are buying at these elevated prices, but the increase in rental price that will likely come in the summer hasn't come yet. So we're kind of feeling around a little bit in the dark, but we're doing it with really good data and with years of experience of knowing that rental prices typically go up. So maybe something is, say, even like a 3% cash on cash today, but in say 2 years, when that rental price climbs, it will have very good cash flow and will likely have grown in value. So there's a little more,
when we put
a little
together
more kind of a dance, a little more kind of faith than maybe years and years ago.
Yeah.
But we still are very much in love with the single family asset because of cash flow and rental growth.
We probably shoot ourselves in the foot by being too conservative, because like in commercial real estate, most people will do like a 5-year projection where they project in, rent growth and all these things. And that's how they're able to deliver, a certain IRR percentage or whatever. And we are so conservative. What we do is we do a year one projection analysis,
which is the worst projection to do.
Yeah, it's the most conservative way we could possibly do it, because the numbers get better every single year.
It's like asking for love at first sight.
Right.
Maybe if you get to know that house for a little bit, it'll produce for you.
Right. Maybe we should do a 5-year analysis or something like that. But so we just are so darn conservative. That's the way we approach it. Those are the pro formas that we present to our clients. And basically what we're saying is like, this is the worst it will ever be in all likelihood. But these are the most certain numbers we can deliver because it's the most immediate in the future. And if you're okay with this, like your follow-on years are going to be probably pretty good years.
Yeah, absolutely. Well, thank you so much for coming. We know this is a hectic time of day as people are finishing up work, trying to get home, trying to relax. We really appreciate your time. Love seeing so many familiar names and also seeing some names that we haven't seen before. So we're excited to connect with you. We did these in the fall, and then kind of stopped doing them as our schedules got busy, but we're really committing ourselves to doing these.
Not that we're less busy now.
We're not less busy. We're just making a commitment.
Yeah.
So our next one is May 26th at 7 p.m. Central. We're going to bop the time around to kind of capture different people's schedules and time zones and stuff like that. But we're also very committed to sending out the recordings for those of you that sign up, whereas before we weren't recording them.
Mark your calendar.
So mark your calendar. I'll cut and paste the link one more time into the chat if you'd like to go ahead and sign up for the May time so that you get the emails, and then you're definitely getting the recording as well. We're so excited to connect with all of you. And if you have any questions or want to talk about anything specifically, just reach out to us.
Oh, and we're doing net worth coaching as well. That's coming up here.
Net worth coaching is coming up on Wednesday, May 5th. That's at 11 a.m. Central. It's for an hour. We will have a recording of that. We don't quite have it worked out with our media people to email out that recording. So we'll probably put that recording in our Facebook group, and I'll put reminders of that in our Facebook group. So look for that in the Facebook group, and then look for the recording of that in the Facebook group. But if you can come live, it's an interactive thing. We really strongly believe that you can't manage what you don't first measure. That's true for things like cooking and weight, and it's very true for money. So we measure our net worth every month on the 15th of the month. We've been doing it for about 11 years now, and we've had great success with that, and we want to share that with all of you. So we'll be hosting that once a month. So try to make it live if you can, otherwise we'll put the recording in the Facebook group. So
thank you so much.
thanks everyone.
Have a good evening.
Have a good night.